We've got one day after the Fed cuts rates and signaled more cuts ahead, at least through the end of this year. We've got stocks jumping to record highs, bond yields moving up as well. So here to explain all of this, Allianz Chief Economic Advisor and former PIMCO CEO, Mohamed El-Erian. Mohamed, it's great to have you back on the show. Welcome.
Thanks for having me, Morgan.
Man, talk about volatility in the Treasury market here. I mean, you had a 10-year yield that broke below 4% at one point yesterday in the midst of Chair Powell's speech and on the heels of a rate cut decision. And now we're at 4.116. What's moving yields higher, and is this the right reaction from the market here?
So two main things push yields higher. One is the jobless claims number. As Rick said, that was quite a number. If you look at it, it's the biggest weekly decline in 4 years. And then the second thing is that people are starting to realize that when you look closely at the summary of economic projections, if you look closely at the dot plots, there isn't that big a support for 2 more cuts. It was only by one member. So I think people are sort of revisiting the initial reaction to this was exactly what we wanted. We got the 25 basis points cut. We've only got one dissenter, so things are fine. And guess what? They've now got 2 cuts. People are realizing it's much more complicated than that.
So based on the data, your analysis of the data, the idea of this being a risk management cut, as Powell put it yesterday, does that make sense?
It does. I would have gone a step further, saying we are prioritizing the risk to the employment side of the mandate relative to the risk to the inflation side. That's not to say inflation is going away. It's not. In fact, if anything, inflation is going to go higher. But the biggest risk to this economy right now is the employment side. You do not want the cliff effect when companies go from hesitating to hire and start firing. Because when companies start firing, that has a way of spreading through the economy. So we don't want to get to that point, and the Fed should be as supportive as it can to stop us from getting there.
Mohamed, the Fed Chair Powell talked about the risks being balanced and two-sided. It sounds like you see them a little bit heavier on one side, or maybe significantly heavier on one side than the other.
I do. I think they are two-sided, absolutely. And let's not forget that with the new projection, the Fed will have missed its inflation target for 7 years in a row. I mean, that's a very long time. And 6 of those years, the inflation has been or is likely to be more than half a basis points above, more than 50 basis points above the target. So that's a major issue. Chair Powell did pivot because he said that while we have risks on both sides, he's paying some more attention on the employment side. And that's what justified the cuts. Otherwise, with the projections of higher inflation, higher growth, it's really hard to justify a cut unless you worry about the risk to the employment side.